The world economy is losing steam due, in part, to the continued fight against inflation. That's according to the International Monetary Fund's latest Outlook report, which paints a bleak picture of how the rising cost of borrowing is affecting individuals as well as businesses.
There are growing signs that global activity is losing momentum. The global tightening of monetary policy has brought interest rates into contractionary territory. This has started to weigh down on activity, slowing the growth of credit to the non-financial sector, increasing households' and firms' interest payments, and putting pressure on real estate markets. In the US, excess savings from the pandemic-related transfers, which helped households weather the cost of living crisis, are all but depleted. In China, the recovery following the reopening of its economy shows signs of losing steam, while there are continued concerns about the property sector.
Our reporter Janelle Dumoulin spoke to Petya Koeva Brooks. She's the Deputy Director in the Research Department at the IMF. She asked her what effect China's faltering recovery is having on the rest of the world.
Now, when it's been a very rocky road, and this is, we have been in this situation with elevated inflation for a while now. But at the same time, now we're seeing signs that inflation is turning around. Headline inflation is coming down. Core inflation is more sticky, but by and large, the global economy is on track, recovering, although we're not out of the woods yet.
Not out of the woods yet, and news keeps happening, like, for example, the recent pullout of Russia from the Black Sea Grain Initiative that could lead to higher food prices. How do you think that weighs on the outlook at all?
When Russia's blockade of Ukraine happened in the spring of 2022, wheat prices increased by about 37%. And then eventually, the deal contributed to the decline in food prices in the subsequent period. So now, when we think about what it means that the deal is being reversed, now there are obviously going to be risks to food security, and of course the biggest impact is going to be on the countries that depend directly on shipments from Ukraine. Many of them are in North Africa, some of them in the Middle East, some in South Asia.
I wanted to zero in on Russia a bit more. You increased your forecast for growth in Russia to 1.5%. Where is this growth coming from?
A lot of it seems to be related to fiscal support, domestic fiscal support, which is related also to defense expenditures, and that is also having an impact on the broader economy. At the same time, we do like to point out that in the medium term, we are still talking about our projections still show the level of output in Russia being significantly below of what it would have been without the war. And some of that is related to less technological transfer, fewer capital goods being accumulated, which really has an impact and will have an impact on productivity growth in Russia.
I would also like to address China. What sort of impact does China's underperforming recovery have on the other parts of the world?
If you look at the composition of global growth, about half of it this year is accounted by China and India. So again, just to keep that in mind. Now, when it comes to the fight against inflation, we do have a reduction in our forecast for inflation for this year globally. And this is almost entirely accounted by China. The fact that in China, unlike the rest of the world, inflation is actually much lower. So that is also an interesting fact, I would say. So again, we need to also really differentiate in terms of what's happening with inflation in different parts of the world, and maybe the most stark example of difference is China.
You've also highlighted in the World Economic Outlook the risks of geoeconomic fragmentation, of the world sort of hiving off into economic blocks. What sort of blocks are we looking at, and how close are we to this kind of fragmentation?
One can think of a whole spectrum of scenarios. A world in which there are different blocks and they really don't trade with each other or don't interact, or much milder fragmentation scenarios where they're just barriers to trade and to foreign investment and such. We've tried to quantify some of these effects and to think about what it means. And our sense was that in the most extreme severe fragmentation scenarios, we could be talking about a loss of output at the global level of up to 7% in the medium term. That would be a very bad thing for the global economy.
Thank you very much, Petya Koeva Brooks, Deputy Director of the International Monetary Fund. Thank you for your insights.
Thank you very much.